Loss of credit capacity. Let's talk about that. Loss of credit capacity has several aspects of it to be considered. The first is accounts are canceled. That is as much an extreme example of loss of credit capacity as any. There's also that the account is not canceled, but that the credit limit on the account is lowered, and typically the limit on the account equals the balance that's owed on that account. So while it is technically active, there are no more charge privileges on that card. There is also the loss of the ability to refinance. That's a loss of capacity. And one of the other factors involved with loss of capacity is if the interest rates to an individual are increased, that typically will have the ripple effect of lowering the amount of credit that is affordable. If the interest rate on a loan goes from X% to Y%, and as a result, the interest payment goes up by 20 or 30 or 40%, as it is not uncommon in adjustable rate mortgages, all of a sudden that credit account is no longer affordable at the capacity. Now that's what you want to think about with loss of credit capacity. Loss of credit expectancy is a type of damage in which the future of an individual's or a business's credit is at stake. Pre-injury credit is the baseline and is the documentation of credit that has been developed and has been extended to the plaintiff. That is the result of conscientious or not credit payments, and a reputation has been developed, and based on that reputation the borrower has an expectancy of being able to get the kind of credit at typical rates similar to what they had before. If they were an A-rated borrower before, then they expect to be an A-rated borrower after, because they have developed that lifestyle, that financial style. When that is removed, when the credit applications are denied outright, or the credit applications come back with higher than rates and charges and an increased deposit, then the expectancy has been damaged and in the extreme lost entirely. Lost entirely, of course, is denial, total denial of the credit. And if you go from having credit to not being able to get credit, you are experiencing loss of credit expectancy.